Welcome to this explainer. Okay, today we're decoding something really fascinating. Why highly regulated financial franchises, your major banks and massive insurance firms, are basically considered these ultimate unshakable fortresses for long-term wealth building. If you've ever found yourself wondering how certain investors just sleep so soundly while the rest of the market is completely panicking over the latest tech disruption, well, you're in the exact right place. We're going to unpack the entire architecture of financial resilience.
To really grasp this, we'll break down this fortress layer by layer. First, we'll look at the ultimate investment moat. Then, Layer 1, regulatory barriers, Layer 2, diversified engines, Layer 3, transparent dividends, and finally, the core investment logic. Let's get right into it. Section 1. The ultimate investment moat and why exactly banks don't just disappear overnight. We constantly hear about flash crashes just completely wiping out hot new tech companies overnight. But an economic moat in finance? It's not some viral app. It's a heavily guarded environment. It's this deep structural advantage that's actually enforced by strict government regulations and insanely high licensing thresholds. Just think about it for a second. Literally anyone can code an app in their garage, right? But you can't exactly start a national bank on your laptop. It just doesn't work that way. And this essentially engineers a highly stable playing field that practically guarantees predictable profits. Moving to Section 2, Layer 1, regulatory barriers, also known as the indestructible walls. So here's the deal. Financial entities are literally the absolute lifeline of the national economy. And because the stakes are just so incredibly high, governments simply cannot afford for them to fail. Period. So they end up acting as these massive gatekeepers. They impose extremely strict capital rules, which essentially means demanding massive mountains of cash stay locked in the vault, along with super high standards for risk control. These special franchise rights basically lock the existing market share right in place, which makes it practically impossible for newcomers to just suddenly breach the walls. And this absolutely hits the nail on the head. It perfectly illustrates why you don't see century-old banks suddenly getting overthrown by, two guys operating out of a garage with the ping-pong table. The barrier to entry here isn't just writing some clever code, it's getting actual government permission and navigating absolute mountains of regulatory compliance. It's a whole different ballgame, and that's exactly what grants these institutions this profound, almost bulletproof long-term survival resilience.
Section 3. Layer 2, diversified engines. Let's step into the fortress armory.
Now, moving inside the walls of the fortress. Modern financial holding companies, well, they definitely don't just rely on a single trick to make their money. They use a highly comprehensive business model. Actually, this cross-industry complementarity, that's their real secret weapon. What it means is they have multiple engines running all at once, completely designed to weather basically any economic storm you throw at them. It ensures stable earnings whether the economy is absolutely booming, totally busting, or struggling with high inflation. Let's look at exactly how they build this continuous profit cycle using three massive engines. First up, you've got the banking arm. This captures super stable yields from the simple spread between the money you deposit and the loans they give out. Second, the life insurance arm. They take those long-term premium payments and just masterfully invest them over decades. And third, the securities arm. This one thrives on market heat, literally raking in transaction fees whenever trading volume spikes. So think about it. If banking is a bit slow one year, well, securities might be totally booming. The scales are almost always perfectly balanced.
Section 4. Layer 3, transparent dividends. Let's open up the treasury.
You remember those super strict regulators we talked about guarding the outer walls? Well, they also keep the inside of the fortress impeccably clean. Because these regulators are constantly watching, the companies absolutely have to maintain crystal clear financial reports. There's literally no way to hide bad numbers. And this intense level of transparency naturally creates highly mature, really predictable dividend policies. Ultimately, it gives you, the investor, a crystal clear line of sight right into the treasury surplus.
This exact combination of high transparency and incredibly stable cash payouts is exactly why large financial holdings are globally considered the absolute top choice for dividend investing. In fact, in Asian markets, they even have a specific term for it, kungu, which roughly translates to saving stocks. And they offer these highly reliable, attractive yields that act as a phenomenal buffer against inflation. Why? Because when prices go up, interest rates usually follow suit. These massive financial machines just adjust their rates, and the cash keeps flowing right back into your pocket. It's a brilliant setup.
All right, Section 5, the core investment logic, and how this all translates to building your long-term wealth. So, what does this all actually mean for you and your portfolio?
Well, standard investing often feels like you're constantly chasing explosive growth, right? It's super high risk, it totally relies on unpredictable miracles, and honestly, it's incredibly stressful. The fortress approach, on the other hand, is completely different. It leverages something called operational inertia. It basically relies on this massive asset scale to produce a quote-unquote boring but highly stable cash flow. The real secret to this moat isn't trying to find the next 100x tech stock. It's simply buying into massive, established inertia that just quietly prints cash for you year after year.
It all breaks down into this really beautiful, highly predictable sequence. Step 1. The heavily protected enterprise generates stable free cash flow. Step 2. From that cash, you receive your cut through annual dividend returns. Step 3. By reinvesting those dividends, you activate the absolute mathematical magic of compound interest. And finally, step 4, you just sit back and let that compound interest do all the heavy lifting. Suddenly, those seemingly small annual payouts completely transform into an immovable, rock-solid financial bedrock for your future.
So as we wrap up this explainer today, I really want you to take a hard look at your own investments. Ask yourself, is your financial future built on the incredibly stressful hope of daily market miracles? Or is your wealth securely locked inside a financial fortress, quietly driven by unshakable operational inertia? Ultimately, how you choose to build your own economic moat is entirely up to you. Thank you so much for joining me for this one, and I'll see you next time.